Alrighty. Hey, Greg. This is, well, hey, Greg, and hey, all of you everyday traders. This is Eric Hale with Trader Oasis. And today I'm joined by Greg Jensen.
Glad to be here.
You got to talk, then the microphone, then the camera goes to you. So what's happening in Idaho? Weather's okay? People aren't here to talk about the weather. The reason we did this is we promised we'd do some updates on CPI, and today we got the CPI report. Let me change to share on my screen. I want to try and keep these as quick as possible so that they're useful for people. We don't mind getting into the details as necessary, but so today's all eyes were on this CPI report for the month of September, released by the Bureau of Labor Statistics. We saw a pretty interesting response from in the futures this morning. I don't know if you were up watching the futures. I was, and this doesn't actually capture the futures. This is just showing, but we had a big move down. We were flat. Actually, we were up this morning. Then the BLS number came up. The BLS, I said CPI number came, and we gapped down pretty significantly. So what were your first reactions on the CPI report and headlines, Greg?
Well, first reaction it was bad news. It wasn't a good piece of data. Inflation is still here, and I think the concern that maybe the market showed initially may have been, okay, is inflation entrenched? But to be honest, the reaction was bad. And it's been bad. The bigger question, I think, was what's caused the turnaround? I know maybe I'm jumping ahead on that, but the data itself was bad. Inflation's still here. It's not growing rapidly, but the question is it entrenched now? And are we going to battle this inflation for a while? The Fed hasn't changed tone. So I think that's what initially caused the big gap down right at the open.
Yeah, I think what we saw probably was a response to the headline news.
Yeah.
We know that there's a lot of automated trading that's out there that trades on sentiment. One of my favorite stories is when Bill O'Reilly from Fox News, all the Me Too news broke about him, that O'Reilly Auto Parts tanked on that news just because there was negative sentiment tied with O'Reilly, and people look for a stock. But different situation here. I do think that there is AI out there that trades automatically based on sentiment, and the CPI report came in arguably worse than expected on the headline numbers, and even especially on the core number. So I want to drill a little bit further down, like we like to do, and looking, if we read into the report, there's a number of charts that we can look at to see stuff. I prefer to do my own data. One of the things that's released is there's table 6, which is part of the annual release that looks at the month-to-month change. And there's a boat ton of items on here. We talked about everything from cupcakes to video game rentals. There's roughly 340 items that are on here that the BLS looks at to determine inflation. And what they do is they apply an importance weighting, a relative importance weighting. In this category is the importance. So example, food rates a 13.6. It's not the highest. The highest is actually cost of shelter, which includes rent and retail real estate prices are worked into that. If we were to take a look at the chart here, so here's a pivot table that I did that looks at what went up and what went down. So this is sorted based on percent changes of those items. Now, I don't have all 351 in here. What I do is I look at, if you notice, these are nested. So I look at level 4, which is a high enough level that we can take a look, and it's manageable. It's still a lot to look at here. And if we so we're looking at the blue lines of what went up, and certainly the things that went up, we're looking at jewelry and transportation, sugar. So we're still seeing, I don't know that jewelry is a big of a concern, although that's interesting, but definitely things that do affect people, food and different components of food. The biggest one, of course, and this is the most important one, which is rent of shelter. So this is not just rent. It looks at sort of owner equivalent rent as well. So it's basically cost of living for paying for your shelter, and that's one that has the highest. Now, so this table's sorted by the change, the month-to-month change. If I sort by relative importance, we can see that the important stuff. So the most important things are at the top. The ones that are outstanding as going down, which are good, is gasoline, used cars are going down. And if we sorted the other way and looked at what was the bottom, it's fuel oil related stuff. And that's certainly, we talked about what's happening with releases in the Strategic Petroleum Reserve to try and get oil down. But this is the big one here. Is that rent of shelter, which is the most important one, was up significantly. It wasn't forecasted to be up 0.8. So I think initially this wasn't, I guess I wanted to go back to Waller's speech from last week. We talked about that, I think, on the last episode.
We did.
Waller did a really good job of telling us that this CPI report was going to be high because of this component here, rent of shelter. And my logic is that if we looked at what happened with the S&P 500 today, if we saw this big gap down, is that probably the adults in the room realize that the Fed has been communicating to us and did a good job telling us. So I think the narrative, we try to backfit what happened in the market and say, what's the narrative that explains this? And my argument is this morning it was the bots, and then it was the humans and the adults in the room by the afternoon is my thoughts here. So I have a little bit of hope here seeing this, because I don't think there was there was this issue about Fed credibility and the Fed saying, hey, we're going to do what it takes to get inflation under control. And that was my read for today. Do you have any response or any thoughts to that?
Yeah, I don't. You're more optimistic than I am. I'm thinking that what we saw today was a sell the rumor, buy the news reaction. So again, sell the rumor. We've been selling off for 2 weeks pretty hard, and it was all on inflation. And of course, the headline one that the media likes to latch onto is CPI data rather than the PCE, which the Fed has told us is their preferred measure of inflation. But they like to latch onto CPI. They get excited about it, and the market has sold off in anticipation of this release. And I think once the data came out, I think you're right about the bots. That's probably what gapped us down because they trade on headlines. But then I think we've seen we are seeing a massive short covering rally right now. I think people who have been profitable in their short positions in the market are covering because the event that they were short from has happened. And now that the CPI data is behind us, they're going to take some profit and look for a new place to go short again. Here's why I say that. I don't think the narrative has changed. The bond market is still down on the data. The bond market's not really rallying like the stock market is. The probabilities for rate increases have just actually gone up from today. Now, maybe it's changed throughout the day, but what I saw earlier in the day is that we're now pricing in not only a 75 basis point move in November, which is 100% now, but we're now seeing.
Oh, come on. It's 99.8. Don't exaggerate.
Okay. All right. 99.8. We're now seeing a 75 basis point move in December as well, getting priced in. Just a couple of weeks ago, that was only a 50 basis point move being priced in December. We're now seeing a 57% of a 75 basis point move. So I personally think the stock market's getting it wrong right here. I don't think the Fed has changed narrative. And in fact, I think the data from the housing data does further cement that they're going to have to stay tighter for longer, which means the stock market's it can't rally in the face of rising interest rates. I go back to, I was so convinced back in 2020 that the fundamental data was so bad that the market had to go down. And I made the mistake. I shouldn't say I made the mistake. I actually had a really good year trading in 2020. I could have done a lot better if I would have believed the Fed sooner as to what they were doing. Because I agree with you. I think the Fed credibility issue, it has been what's in question. But what I think the mistake is that the Fed is going to fix things. I think the Fed is going to stay aggressive cutting rate, or excuse me, raising rates right now because of this. So personally, and you look at it in the breadth too. Now, I say that in the S&P 500 breadth, if you looked at a heat map of FinTwit today, it's pretty green. You would think it'd be more green. I mean, surprising the S&P and the NASDAQ are up as hard as they are, and Amazon's actually down today. There's a handful of stocks on my watch list that I've watched the last few years that are red today still. So it's only about a 2-to-1 breadth right now. It's more than that in the S&P. But overall, what you're seeing is a lot of the high flying names that I think if we were truly hitting a bottom and trying to bounce off this, you'd see some of the really high flyers, although some of them have turned green more recently, but even Amazon is almost up, but some of them are barely up. I'm talking about the names like Snap and Airbnb, and Intuitive Surgical actually is having a pretty good day. But a lot of these smaller names that are more speculative are still red today. So maybe they'll be green by the end of the day. I still think we're in a short covering rally, and I'm going to look at a time with it may continue this through tomorrow too, because the market has clearly turned bullish today. This change in momentum is definitely bouncing up that, but maybe I'm wrong. I know that historically, you pulled up some data earlier today that, the average duration of a bear market, and we're getting pretty close, right?
Yeah. So the average bear market lasts 289 days, and we are 286 days into this year. So I don't know exactly when the bear market would have begun from the last high. So we're within days of that. So you pretty much started January 1st. So the first period, like December 31st or January 2nd or 3rd or something, would be the beginning of the bear market that we're in, because we are in a bear market. So like I said, average duration of that, and that's where the point. So I'm calling a bottom here. No, don't ever let anybody who, you know what, you should call a bottom every day, and then maybe you're right. But I'm going to take a counterpoint to your point. I do agree that certainly the Fed is definitely driving the market, and I don't think that the Fed is going to step in and support the S&P 500. That's unfortunately for the past year, that's been what's happened. The Fed is here to support the economy. I think the bigger focus is, like we talked about, debt being an issue. Inflation gets out of control. We do have issues with debt, and when inflation gets endemic, it's difficult to get rid of. So I think the Fed is afraid of that, is going to do whatever it takes. And if that means push us into a recession, that's what they're going to do. Looking at the other data from the FedWatch tool, if you click on the probabilities, we talk about a terminal rate, and this is where does the Fed believe, not the Fed, this is where the market believes the Fed will peak out at its rate. And we've got a 125 basis point hike. They're saying that we'll terminate somewhere around 475 to 500 basis points somewhere in February. And that's what the market's pricing in the FedWatch tool here. That's pretty interesting. I think this goes back to the Fed credibility, and that the Fed can continue to raise rates. The issue with the market is, if that's what the market expects, it's going to be fine. And I think the market can find support. I think the market can even turn around here. So I'm on the other side of that. I agree with the data. I'm just reading it a little bit differently than you, Greg, which is fine. It's just, I want to, I'm not trying to put a counterpoint there, but you know what?
It's what makes a market, right?
Yeah, it is what makes a market, is two people on the other side thinking different things. So I do think we've seen this volatile year historically. I've showed the data a few times that midterm years tend to be volatile, and right about now is typically when we start to see bottoms and things turn around. And I'm expect that we could still see some big pullbacks, but I think beginning in November, I'm going to start to change my position a little bit in terms of my bullishness overall. But I'm pleased with the response of the market today. This is a really big candle. This is a notable candle. This is one that if we end up here on the highs, this is one that will get a lot of attention and potentially be seen. It could be seen as a reversal point from a technical standpoint. So that's what I'm keeping an eye on here. I think the other big stuff, is there anything big coming up other than this? We're starting to get into earnings season, I guess.
Well, we are starting to get into earnings season. We're creeping closer and closer to election season too. We're less than a month away from the midterms. And I know you and I have talked about that being a still potential volatile event. But once we get past the election season, once we get past the midterm elections, I think that it does open up a potential for a rally. And I actually agree with you that I think we may have put in bottom. We may not. I don't know that for sure. But what I do know is that historically, you're absolutely right. The end of the year and the end of a midterm election year are usually very bullish. And so I actually think there's a chance to play the seasonality of that. I may actually go bullish short term as well. And I might go bearish again, maybe around February, when I think the market is wrong about how far the Fed's going to have to go. I think the Fed's going to have to go further than that. And I think we'll see the market start to change, because I don't think inflation's under control. I think they're going to have to continue to raise rates, maybe even into the middle of next year, before we see inflation under control. But and so maybe I might go bullish from November until February, and then I might go short again. But yeah, for the time being, gotta love the volatility, right?
Yeah, gotta love the volatility.
Good for option prices.
I think the key item to keep an eye on is this rent of shelter and property prices. And with 30-year mortgage now over 7%, and I saw 7.5 somewhere last week. I don't know if that's the average, but that is definitely, we're seeing news on property prices coming down. And I have a friend of mine looking to shop for houses, and he's got a watch list, and he keeps getting notifications that property prices are dropping on his watch list.
Yep.
So that's what we need to see. Unfortunately, it's going to happen. There's just there's lags in the response. So the policy takes effect, and there's an intended consequence. Unfortunately, it takes longer than a month. Sometimes maybe it's on the order of 6 months or closer to a year for that to play out. So we just need to keep an eye. I'm really happy with the way things turned out today, because I wasn't sure what to think. I knew we were going to have a bad CPI number. I knew it was going to be higher than the consensus based on Waller's speech. But the market responding to it tells me that the market is starting to listen to what the Fed has, and they're building credibility, which, I don't really care. I don't like what they're saying, but the reason it matters is because we know what to pay attention to see what's going to move the markets.
We'll see where we are in a couple of weeks.
All
Hopefully,
right.
I hope you're right. I hope you're right. I hope I'm not right. That it's just a short covering rally and we see lower lows here in a couple of weeks. But
that reminds me, there's one other thing that I wanted to share. This is a completely separate thing. I was reading this morning, came through from my Barrons, and I know I didn't talk to you about it, but you'll pick up pretty fast. So Steven Sears writes the options column in the Barrons, which comes out weekly on Saturday, but he wrote this one today regarding a massive position. 50,000 VIX March 150 calls.
150.
Your reaction was classic. I'm glad you didn't see this ahead of time. So explain what that means.
I don't know if I've ever seen the VIX at 150. I don't even think we.
No, you never have.
I was going to say, I don't remember being there even in the COVID panic when I forget the guy's name now. Dang it. The guy that argued on CNBC, who was crying at the bottom.
Oh, let's talk about Kramer too later. Kramer, they know nothing. No. Who was crying at the bottom?
No, at the bottom of the Fed, the COVID low. Anyway, he was crying.
So here's the VIX. So to be clear, this is not the VIX. That you don't buy options on the VIX. You buy options on VIX futures, and the VIX futures tend to run much higher than the VIX itself. We can pull up a chart on that, but traders should be very careful. But what this is saying is that some trader is, and they were only 19 cents, I think, was the contract. So they were 19 cents a contract, 50,000.
Bill Ackman.
Oh, Ackman. Yeah.
That's who was crying.
Yeah. So there's somebody out there that's making a bet. Now, is it a bet or is it a hedge? It might be a prudent hedge. I mean, this is one of the things that's really, you got to be careful with when you look at options flow data, is you have no idea why somebody is doing something. I always tell people, like, when you see a big call purchase on a stock that's heavily shorted, that actually might be a bear. Somebody's selling the stock short and buying calls to protect themselves. And you might see a huge, it could be one of these whales that are known as being huge short sellers. The Michael Berry or Icon or Einhorn or somebody out there. Who's the other one that ticks me off?
Ackman.
Ackman too. No, there's the other guy that's always short, got an accent. Anyways, he's always I can see his face, but his name isn't coming to me right now. But they buy calls.
Rubini?
Yeah, Rubini doesn't short so much though. I don't know.
That's true.
He's not a short seller, but short sellers will buy calls. So you see this big call volume on a stock that's heavily shorted, and you might see it's a bullish signal. So we don't know why this person bought 50,000 calls on the VIX futures. It's certainly noteworthy. It's the largest trade that's ever been placed. The VIX has never been at 150. It's certainly noteworthy and something to think about. So, your potential, maybe it's just a hedge for somebody who's got a rather large position, or maybe somebody's trying to place this as the trade that they want to make money on. Who knows?
I was going to say, I'll bet you it's the opposite. I'll bet you it's an outright gamble. It's just a really big gamble.
By the way, my back testing on the VIX, using VIX calls as a solution to hedge, I think you're far better off buying puts on the SPX unless they're very short term. Very short term long calls will pay off better. The problem is they usually lose money. So if there's going to be the bottom's going to fall out, a short term VIX call does very well, but the problem is nobody knows ahead of time. This is just from back testing. I think you're better off buying S&P 500, either the SPY or the SPX puts is probably the best.
I agree with that 100%. I think the VIX is much more difficult to time and trade than the SPX is, or the SPY.
Right. Yeah. It's the VIX is an evil instrument. It's a quagmire. I think the people is, if you understand it well enough, you wouldn't trade it. So the people who trade it are the people who manipulate it. So if you understand the VIX well enough, you probably wouldn't trade it. Anyways, other stuff. The markets, like I said, is the tone is definitely different from this morning. Things are shifting around. Even though inflation's higher, we've seen things turn around. Things are looking good. We got lots of green across the board. So we'll see if this is going to stick or not. Anything else before we wrap things up?
I think it's good for today.
Maybe we should tell people subscribe and which we didn't say at the beginning, but that's
for sure. Like and subscribe, please.
And ask questions. Some of you've been asking questions. I appreciate that.
Yeah, allows us to get a bigger audience and reach more people with our message. So hopefully what we're giving to you is helping you build your macro perspective of what's going on in the economy, and more importantly, what's going on in your portfolio. So thanks, Eric.
Thanks. See ya.